this week we're going to talk about the last 2-3 weeks, if you've been following, we've kind of been sort of following on week by week, and I've kind of been bringing up concepts from a previous week into the current week, and the reason behind it, the logic, is that we're seeing these principles play out, and it's important that we keep building on these foundations, because very, very, a lot of these principles we're discussing are very, very important in terms of, developing your trading intuition and understanding. Okay, so we're going to continue on the theme of auction imbalances. Now, I've had 2 or 3 emails come to me saying, are you still using the footprint charts? And the simple answer to that is, of course, I'm using the footprint charts, but what I'm trying to do is I'm trying to get away from seeing an actual footprint chart and rather interpret the actual footprint concepts. Okay, it's crucial that one of the things that I really kind of find that's quite common amongst young traders is they always want an exact understanding. Okay, so they want to see something exact on a footprint, and then they see it as, for example, an auction imbalance. Right? Trading is not precise, it's not exact. It's anything but precise and exact. If anything, it's about making sure you understand the principle, okay, the core principle, and then applying yourself accordingly. So that's what I'm going to do again today. We're gonna actually bring in the market profile today. I'm going to show you an auction imbalance that we saw, that I showed you guys 2 weeks ago in the oil market, in the German Bund market, and I'm going to show it to you again, show you what the implications were, and then I'm going to show you one of those exact same plays, okay, the exact same strategy approach that we saw in the oil this week, okay, same auction imbalance, same opportunity, same methodology in order to take advantage of it. Okay, and then we're going to talk again about this concept of narratives. Okay, I want to keep sort of pushing on this idea of narratives, because there is something that's developing within the financial markets that it's crucial you understand. Okay, so let's get into it, and let's see where we get to. So we spoke about the low volume areas. Okay, we spoke about what this low volume area means, and how we ultimately execute it. Now, for those of you that missed that stream, it's very simple. A low volume area is an untraded area over a certain time. Okay, it's where there's very minimal amount of trade facilitated. Okay, now when we see these low volume areas, we have to be particularly aware of what they mean. Okay, in a simple sense. Okay, so on a principle-based sense, so long as a low volume area holds, there is effectively an excess positioning in the market. In other words, there's an imbalance in the market. Okay, what it's telling us is that the sellers got very aggressive through a certain price point. In this instance, it happens to be this price point over here. Okay, sellers got very aggressive. We can see quite a lot of volume transacted just ahead of the break, and then no volume transacting at all. Okay, so in other words, whether that was some longs liquidating, and that's why price moved and repriced itself very quickly, or whether that was shorts very aggressively hitting into bids, okay, one and the same, they say the same thing, which is that we've now got some fresh short positioning in the market. Okay, and what we typically see with these low volume areas is, so long as they hold, okay, so long as they hold, they tell us about the short-term positioning in the market and the short-term direction of the market. Okay. In other words, so long as we hold on to this low volume area over here, okay, the market should continue to price lower. Now, this has happened on Thursday the 11th of June. What happened on Friday? Okay, we can see the market opened, auctioned, took out Thursday's lows, right? Came back. Where did it test? 37s, which was the top of the low volume area. Okay, so market retested, and what do we see straight away off of that? Notice the size of these TPOs. Okay, notice the range of volatility there. Right, you should all be seeing that that is the largest 30-minute range that we've had all day. Okay, and where did it come? It came on a retest to that low volume area. Okay, and that's the crucial. A lot of people say to me, "Oh yeah, but that's in hindsight," right? What I want to stress, and this is so crucial, is as a trader, okay, it's not just simply a case of, we sell the market at random levels. No, it doesn't work like that, right? We sell the market, and then when we get this additional piece of information, i.e. that we get a very swift rejection in the C print, that confirms our trade is good. That confirms that our understanding of a low volume area is now justifiable. Okay, that's what we call price action. Right? The market is telling us that the very sellers that were aggressive leaving this low volume area are equally aggressive on that retest. Again, we can see a lot of people are saying, oh yeah, okay, but it's a small rotation. Oil dropped from 37 down to 35.5, 156. Okay, that's by no means a small rotation. Okay, so that's the low volume area. Now, I quickly want to bring up the German Bund so we can just talk about that, and I can show you what it looked like, how it played out, and just show you the similarities between the two. Okay, so this is the German Bunds, and that day type is let's get it there. Okay, so yeah, was the day that it happened. I'm just going to outline it. It was this day here. Okay, the market auctioned very aggressively. We left a low volume area. So where this brown line is, okay, the market left a low volume area. Right? Next day, it extended, came all the way back. Where did it retest? It retested the low volume area. Notice the large wick. Okay, by the way, this is a 2-hour chart. Okay, notice the very large wick. Market then extended lower. Okay, it stayed inside this range before then continuing lower. Okay, and that's what we're looking for in the oil now. Okay, we're looking for a little bit of sideways consolidation before we start to auction lower. Now, surprise, surprise, where did the market stop on Friday? Okay, right back at that low volume area. Now, you should all be going, oh wow, actually, okay, we can very clearly see that this area is acting as a good form of resistance. Okay, and that's all resistance is. It's a point at which sellers are engaging in the market. They're holding a price point. Now, yeah, that's the exciting part. Okay, come Monday, right, this is obviously the stream was done over the weekend. Come Monday, what are we looking for in this German Bund? Right, if we start to hold price above that 175.58, you're very quickly going to see that Bund auction higher. Okay, you're going to see some form of a stop run. Okay, so anyone short is going to start to liquidate those positions. Right, so you can see how these low volume area plays give us really good, not just opportunities to trade, but they also give us very good understanding of the short-term direction of the market. Okay, so let's look at the oil now. Right, so what we can see, there's our pretty little red line. Okay, again 2-hour chart. We can see that low volume area holding quite nicely. Market auctioned lower. It's come back to retest. Okay, now what we're expecting on Monday, right, very early on, we're expecting oil to offer again and come and test that 34.5. Okay, now again, from 36.5 to 34.5 is a 2-point range. Okay, that's pretty decent opportunity. What's it going to cost us in terms of risk? Okay, very simple. Our stop just simply goes above the 37s. Okay, 37, call it 37.10. No, you don't need much more than that. You're taking a 60-tick stop for a 200-point target. Right, so hopefully you're all starting to see the power of this. It's not that this will work every single time. It might not. Okay, it might only work 1 in 4 times, but guess what? You're getting 4-to-1 risk reward every time, which means you're breaking even. Right? In order to determine how often this works, you've got to go do the homework. Okay, I've done the homework. I know what the numbers are. You need to go do that homework. Okay, go look into this. This is not just a profiling concept. It's a profiling concept. It's a footprint concept. Okay, anyone that's done the footprint course, you would have seen these imbalances. Right? They occur all the time during the day. Right? When those imbalances start to effectively get traded out, they offer very good positioning unwinds. Okay, we spoke a lot about that in the footprint course. Really nice strategy where you have these imbalances, they get created at the beginning of the day. All of a sudden, we see the markets reverse very aggressively, taking out those imbalances. Okay, now I just want to show you one of those imbalances because it happened in the gold this week. And if you go back and look on Thursday, and then you go see the gold market, right? It was this day, yeah. Okay, on the cash open, what had happened was all morning, okay, or sort of the previous day, all the previous day, we had been just drifting higher, drifting higher, drifting higher. And the very next session, we just got this wipeout trade. Okay, it was almost like all the positioning got too long in the market, too aggressively. There was a whole bunch of, imbalances within the footprint, and all of a sudden, it got top heavy, and the market just washed everyone out. I mean, that was a decent $20 move from high to low, and it happened very swiftly. Okay, and that was all those imbalances. i.e. positioning. That's all an imbalance is. It's showing us an aggressive nature of positioning in the market. Okay, now let's move on with the stream. So hopefully you understand those auction imbalances and the opportunity it presents for you in the week ahead. Okay, now we spoke about narratives last week, and I want to continue this narrative because all of a sudden there is a new narrative. Right. So last week we spoke about the FOMC. Okay, and the potential for the FOMC, and surprise, surprise, the FOMC did deliver. Okay, it delivered opportunity. Now I'm not going to say it's easy opportunity. Okay, I'm actually going to tell you exactly what I did so you can get an understanding of how complicated the opportunity was. But what I was trying to stress last week, okay, and I saw one or two guys on Twitter this week saying, oh, the Fed's a non-event and there's no point in bothering being prepared. Okay, and I object to that. I object to that fiercely, because if you're not prepared for every single central bank and you just take the lackadaisical, lazy approach of, well, it's a non-event, there's no point in getting caught up, you're doing yourself an injustice. Okay, so what we spoke about last week is the fact that the Fed was tapering. Okay, they were tapering by $500 million every week. We obviously knew that from the Reuters, and the information was coming in week in, week out on Fridays. Okay, and that currently the Fed was purchasing $80 billion a month, roughly speaking. Right now, what we were doing in terms of the FOMC and where we were prepared was we were aware of this number of $80 billion. All right. So if the Fed announced a concrete number with regards to their purchases, i.e. they said 40 billion, okay, we know that's a far aggressive tapering than what was priced in the market. Why? Because the market was effectively tapering $500 million every single week. Okay, so the daily purchases were reducing by $500 million every single week. So we knew that a range of between 40 and 60 billion would be particularly hawkish for the market, and we should see equity sell off and bonds rally. Okay, surprise, surprise, the Fed came out and they said we're going to keep buying at 80 billion. Okay, and you saw me put out a tweet, right? And the tweet was very straightforward. This is quite dovish. In other words, the Fed has now announced what they're doing going forward. They're now going to be buying bonds to the extent of 80 billion a month. Okay, which, given that the trajectory was for a lower amount of purchases going forward, right, effectively it was more dovish than what was priced into the market. Okay, so in other words, should be supportive of risk. What did we get? Okay, so here is our Fed outcome. Okay, these are 15-minute bars. What we can see is initially, okay, the initial mathematical people who are quick, who did the homework, okay, market went bid up from 80s all the way up to 32.25. So a good 45 handle move. Again, a lot of people say, oh, that's not much. Well, it's 1.5% move. Okay, so the market moved 1.5% to the upside. It then washed all those positions out. It then rotated higher again. Okay, now at this point, we had the close, and you can see that it's pretty much, if you were to have just looked at the number but not looked at the information, so not looked at the technicals, sorry, you just looked at the technicals but not the fundamentals, you would have said that this is pretty much a non-event. Okay, heightened volatility, of course, hence the volume, so we would have wanted to have looked what come out, okay, because the market wouldn't move that aggressive on that much volume if there wasn't any new information, but there was new information. Okay, so we go look at the information, and the information was dovish, okay, supportive of risk. Equities finished pretty much flat from the event. From the time the event came out over there to there, we pretty much finished down, call it 15, 20 handles. Okay, what did the bonds do? Bonds were very aggressively bid. Now this is where it's confusing, because if bonds were up 1 point, okay, you look at the US 10-year, they're up 1 point, and the equities are marginally down, that's suggesting to us that there was a dovish tilt to it, i.e. bonds wouldn't rally a point unless there was something aggressive set, which was that they're going to buy more bonds than expected. Okay, so in terms of a narrative, we were correct. The bonds told us we were correct, right? But the equity started to offer, and that's a real clue. And this is where understanding, subtleties in the market is so important. Okay, the fact that the bonds responded the way they did, i.e. dovishly, but the equities were actually weak on a dovish announcement, tells you a lot about the price action of the market. It tells you that there was someone that wanted to take some profit on this announcement. Okay, and take profit. Why? Well, because markets have rallied 40% in the last 2 months. Okay. Now this is where it becomes tricky, and make no mistake, okay, I never like to pretend that this was easy, okay, because for me, coming into Friday, or sorry, into Thursday, my plan was very simple. I wanted to get myself short at some point. Okay, I wanted to be short the market on the signaling that was coming from the market. However, the problem was, by the time, pretty much most traders got to the desk, we were trading somewhere around here. Okay, so this is all the Asian session. And we can see since the close, we've dropped from 3170s all the way down to almost 3100. So we're down minus, call it 75 handles on the day. Percentage terms, 2.5%. Okay, so think about this. Put yourself, and this is why it's so important to always play these things back. Because when I came in the morning, or actually when I did my debriefing on Thursday, I was particularly, for lack of a better word, pissed off. Okay, I was frustrated because I was kind of like, well, why didn't I just sell it? And this is where you've got to go and interpret your psychology, because if I look back on the day, to sell a market that's already down 2.5%, okay, at that point, on the cash open, Europe was down 3%. DAX stocks, IBEX, FTSE MIB, all of them were down 3% at cash open on Thursday. How do you sell a market that's down 3% already? Okay, now, that's the first part, but the second part is the cash open of the US session. Okay, we can see that the cash session for almost an hour and a half, 2 hours, the market just rotated in a 20 handle range. Now at this point, if you've tried to be short, okay, you short with your psychology saying, well, we're already down 2.5 to 3% now, and I'm short in a very dangerous zone, which is what this blue line is, 3100. Okay, what's the probability that we're going to continue on this day? Well, we did continue. Okay, we dropped another 100 handles, another 3 and a bit% move. Okay, so the important thing and why I'm trying to stress this, okay, is because sometimes trading is damn difficult. Okay, this was a difficult day. Not just was it difficult in terms of the psychology of the day, but it was difficult because there was no strategic play. And this is where I'm getting to this. Listen carefully. There was no strategic play on this day. So where was the opportunity? Okay, yes, and a lot of people are going to say, yeah, but you had to be short because of profit taking, and it was always going to come, markets went too far, too fast, all that sort of hoggity-boggity, washy stuff. Right? Remember, and this is crucial, trading is a game of probabilities. Okay, trading is a game of knowing when to engage, when to not engage. Trading is a game of knowing when you've got an edge and when you don't. If you have a little bit of a fragile psychology because the market's down 2.5% coming into the European session, well, I hate to break it to you, you are like most traders. Okay? Because most traders that see logic in markets see the difficulty in being short after a 2.5% move. Okay? Equally, if you struggle to stay short in this 20 handle range, given what happened before, okay, that makes sense. But if we had, now listen carefully, if we had, for example, a low volume area move, a nice auction imbalance, and the market came back and held that low volume area, okay, kept that low volume area for us, by all means, then we push all in, then we execute, then we take advantage. Okay, the reason I mention that, if you go and look at this little time frame on a footprint, you'll see that little bit of an imbalance that came in. Okay, market offered, came back, failed to retest that 3100 key support, started to auction a little bit, and then just continued lower. Okay, now don't be surprised if at some point this week we test that 3190 area and the market auctions off there very aggressively. Okay, 3100 is quite a key little resistance area for the market. It showed us little imbalance that eventually gave us the opportunity. Okay, now the reason I say this is that this was a difficult day. Okay, but the market gave you just a little bit of an inkling there, just a little bit of an opportunity to finally get yourself into the market with a stop that made sense. Right? In other words, it exhibited us a potential opportunity. Okay, so I wanted to stress that narrative because it's too easy to just read the newspaper and, oh, the market sold off because Robinhood traders sold the market. Too easy. Okay, make sure you're aware of what are, objective narratives and what actually move markets and what don't. All right, now the last point I want to finish off with. Okay, I want you to take a little bit of a second and go and look at this chart. This is the NQ, NASDAQ. Okay. Now, don't worry about the lines. The lines mean nothing. What the lines are trying to tell me is that every time this market rolls over, okay, it's forming a higher low. That's all this is showing me. Once, twice, 3 times, 4 times, 5 times. Okay, what's the trend of this market? It's very firmly up. We cannot argue that. Now, a lesson I had to learn the hard way in my career: never ever preemptively, think something is done. Okay, I've been reading a lot of people saying, okay, Nasdaq's turned over, we're going to roll over. Now that we're back below that, that's the previous record high, 97.50s. We should auction low. Fair enough. I can understand that logic. Okay, but the market structure will remain bullish until we take out one of these 5 higher lows. Okay, that's what price action is. Price action is the manner in which the market is rotating. And right now, the market is being bought up every time we have a 5% correction. Every one of these is a 5% correction. Every one of them. Okay, it might almost seem stupidly simple, but it is so. Okay, there's obviously a buy program that's buying this every time it rotates 5%. So what does that tell us? It tells us we've got a very interesting juncture going forward this week. 9,500 now is support. Okay, don't be surprised to see this Nasdaq be at record highs again this week. Don't be surprised. Not because Brannigan says so, not because there's a narrative of buy every dip, not because the Robinhood traders are buying everything, but because the trend in the market is to the upside. Okay, it doesn't matter what the coronavirus infection rates are. None of that matters. Okay, what matters is the technical structure is showing us these higher lows. Until we take out 9,500, you cannot be aggressively selling this market. Okay, once we take out 9,500, by all means, then the structure changes. Okay, then the market can pretty much start to maneuver lower and form a lower range. Okay, have a look at that NQ, particularly interesting, very nice structurally.